some more perspective now. Jason Schenker is still with us, President and Chief Economist at Prestige Economics, who's with us out of Tokyo today. So, Jason, you say that some pretty significant shifts in expectations on the Fed and monetary policy could happen over the next 3 to 4 months. Is that with or without the impact of whatever we see from the trade and immigration and fiscal policies of a Trump administration?
Yeah, so this excludes what we might see with the tariff and trade and immigration policy expectations. Just looking at what is likely to happen with things like the CPI data alone could drastically shift Fed expectations over the next 3 to 4 months. Basically, if you look at the historical data and where we're likely to see CPI come in for the next few months, base effects could send CPI for December, which will be out on January 15th, up higher on the year-on-year rate. In other words, we'll go probably from 2.7% up to 2.9, maybe even 3%. That's definitely the wrong direction that people are going to want to see, right? An acceleration in that headline CPI. Core CPI could accelerate from 3.3 to 3.4, also moving in the wrong direction. And then the result would be that you have a pricing in of fewer rate cuts than we already see. We saw those drastically reduced in the December FOMC projections, where an expectation of 4 rate cuts was reduced to 2. We could see markets price in maybe only 1 rate cut following that CPI report. That could strengthen the dollar, weigh on equities, weigh on bond prices, send yields higher. So you could have a number of different things happen. And as a result, what we could also see is the CPI come in a little bit weaker going forward, though, in the second quarter, where we think the headline CPI number could be below 2%, maybe even flirting towards 1.5%. The result of that would be the opposite impact, where suddenly people are pricing in multiple Fed rate cuts. We go from expectations of maybe 1 or 2 back to 3 or more, and suddenly the dollar weakens, equities rise, bond prices rise, bond yields fall. So you could see this swing in the markets where you could get over the next 4 months that little kid soccer team of expectations runs to, oh no, the Fed won't be able to cut rates, to, oh no, they need to cut rates a bunch. And that's something that could happen in just the next 4 months, excluding what we might see from policy expectations.
What does that mean for broader commodities? For gold, for example, we're still seeing that continue to advance even after, a 27% annual gain last year?
Yeah, I think for gold prices, obviously, if we get a stronger greenback on a CPI number that's going to be a little bit higher than expected, we could see gold prices come under a bit of pressure. But if in Q2, by the time we hit those March, April CPI reports, if we're between 1.5% and 2%, gold prices could rise on expectations of more Fed rate cuts. For industrial metals prices, they're going to behave probably a bit more like what we'd see from equities and from bonds, where if we get that stronger greenback on more inflation in Jan, then you're going to get, with that release on Jan 15th, the December numbers, you're going to probably see ferrous and non-ferrous metals maybe come under pressure here at the beginning of the year. But in Q2 and beyond, there's more upside. And there are expectations, as we see interest rate cuts across the global economy, that industrial metals prices could end the year significantly higher than they are now, because global manufacturing is likely to see upside.
What are your assumptions on the US dollar then?
Yeah, the assumption that we have going into this year is we're going to end the year weaker than we started the year. It'll probably still be relatively strong against most currencies, but because the Fed is likely to cut rates, and we expect 3 rate cuts this year because of these swings in inflation, whereas right now most are pricing in 2, mirroring the Fed's December FOMC projections, we get more cuts than people are expecting. If they're expecting 2 and we get 3, we get a weaker greenback by year end than we started the year. That's something that will reverberate across economies and be more supportive for things like the Japanese yen and even the Korean won, especially once we get past these political tensions that we see right now. There's more upside for those currencies by year end.
Jason, always great to have you with us. Jason Schenker, who's a President and Chief Economist at Prestige Economics.